Alright, so now we are going to look at IAS 19 employee benefits. Now for ACCA students, this standard is a brand new standard that they are being introduced to at SBR level, because this is not a standard that they have experienced or seen at FR level or FA level. Therefore, this is a new standard that the students need to understand and master in order to face any questions that come through this standard with precision. All right. Right. So now what does this standard mean? Technically, by the term, you understand that it is employee benefits. Now, employee benefits usually is the benefits or the compensation that is paid to the employees. Now, who are the employees? Employees are the individuals that are providing service to the organization. So in return of that service, the organization is supposed to make payment or compensation, right? So any compensation that is given in exchange for the services that the employees have rendered is what we are going to look at under IAS 19 employee benefits. Now, when you look at employee benefits, as we just understood, employees are going to deliver a service, right? This is what the employees are delivering. And what are they delivering this service for? What are they delivering this service for? They're delivering this service to earn something, right? So that compensation that the entity is supposed to pay is for the service that they have rendered. Okay? Right. Now, when you look at IAS 19, IAS 19 has different categories of employee benefits that are covered, because if you look at the practical context of the organizations, the employee benefits can take different forms. So one of those forms is short-term benefits. And one of those forms is long-term benefits. Okay? So short-term, we understand that any benefits that are to be paid within 12 months. Within 12 months, right? After the reporting period. Okay? In which the service has been rendered. But when you look at long-term benefits, these are the benefits that are to be provided beyond 12 months after the reporting period. Okay? This is 12 months after the reporting period. Now, what are some classic examples? What are some classic examples of the benefits that are paid within 12 months? Those who are employed, they know that there are some main benefits that are short term. One of that is wages or salaries. Now, this is the main type of compensation that the employees are expecting. But apart from this, there are other benefits that are provided as well, such as paid absences or paid leave that we call, right? Paid leave, bonuses, right? Now, wages and salaries can take different forms. It can be basic salary, it can have allowances. Okay, so this is what short-term employee benefits are. Why? Because these benefits are provided within 12 months. Okay, then there is long-term employee benefits. Now, when you take long-term employee benefits, now this category looks at multiple different angles. Okay, multiple different angles. So there is termination benefit, termination benefits. Then there is post-employment benefits, right? Post-employment benefits. Now, this is very important. Okay, but because this is where the most meatiest part of the standard is. Okay, right. And then there are long-term benefits that are neither termination nor post-employment benefits, right? So these are other types of benefits that are provided 12 months after the reporting period in which the employer has rendered the service. Okay, right. So when you look at short-term benefits, what is the usual accounting that you do? There is an expense that you record, and there is a liability that you record. Now, liability is for the ones that you are obliged to pay but you've not paid, right? Or if you've paid, cash is going down. Okay? So, how does the double entry work? How does the double entry work? Debit, expense, employee expense. This goes under operating section of statement of profit or loss, and credit, accrued expense or cash if you've settled in cash. Okay? Right. But when you look at paid absences, there is specific guidance that is provided by IAS 19. Right? Now, when we look at paid absences or paid leave, now this could take two forms. One is accumulating and one is non-accumulating. Okay? So accumulating paid leaves are the leaves that you can carry forward. Can be carried forward. Okay? Can be carried forward. And non-accumulating are the ones that cannot be carried forward. Can't be carried forward. Okay? This is the absences that cannot be carried forward. Okay? Now let's assume that there are 25 days of leave that the employees are entitled for. This can be sick leave, this can be annual leave, this can be casual leave, right? So there are different types of leaves that are there. Now this 25 days, if it falls under non-accumulating category, meaning you cannot carry it forward to the next year, then you are going to expense only when employee uses it. Okay? Only when employee uses these leaves. But if it is, now this is for non-accumulating leave. Okay? Now if it is accumulating, meaning employee can carry it forward to the next year. So in that case, what happens is the organization is going to recognize an expense when the employee is entitled. Okay? So there's an expense when the employee is entitled. We'll come to what entitled is. And a liability, a corresponding liability. Right? So corresponding liability. Now this liability is carried forward if these leaves remain unused at the end of the period. Okay? At the end of the period, these leaves remain unused. This liability is carried forward. Okay? Right. So what does entitled mean? Now 25 days of leave is for 12 months, right? Days for 1 year. So entitlement meaning 25 divided by 12, so that's going to be approximately 2 days, right? Approximately 2 days per month. Now this is what entitlement is. Every month, the organization will be recognizing an expense for 2 days worth of leave and will be posting a corresponding liability. Okay? So let's say the salary is 100,000. 100,000 is the salary, right? Divided by, now this is for the month, 30 into 25. Now this is going to be the total amount that will be paid for the leave days, right? Now whatever the figure is here, right? Whatever the figure is here, that you are going to divide by 25 since it's for 25 days and multiply by 2. That's going to be per month. Okay, so that's the entitlement. So that's a paid absences. So short term, technically, you are going to recognize an expense and a corresponding liability. The liability which will be settled within 12 months, and after 12 months it is settled, you are going to de-recognize the liability and reduce your cash. Okay? Right. Now that is short-term employee benefits. Then we look at long-term benefits. Right? Right. So here, other long-term benefits is what we are looking at first. Other long-term benefits, meaning non-termination and post-employment. Okay. Now this follows a similar treatment. Now, if you look at post-employment, before we discuss what it is, I'll give you what are the two areas under that. One is defined contribution scheme, and then defined benefit plan. Okay, defined benefit plan. All right. Now this part does not include termination or post-employment, but the ruling or the accounting follows a similar accounting like the defined benefit scheme, but it's more simpler and more straightforward. Okay. So other long-term benefits are the benefits that you provide beyond 12 months, right? So, there is going to be a liability that you are supposed to record. Okay. All right. A classic example here would be disability benefits, right? Disability benefits. Now, this is the benefit that's provided to the staff who become permanently disabled, right? So that's a benefit that the organization provides to the staff that are permanently disabled in order to assist them in some way. But if you take an organization, not all the staff are going to become permanently disabled. But this benefit is an entitled benefit on the staff that become permanently disabled. Which is why there is an estimate that you are supposed to make as to how many staff out of total staff are going to be permanently disabled. Okay. Now let's say you have an employee base of 1,000 and you estimate that 2% of them will be permanently disabled. So that's going to be 20. Right. So you are going to, so this works like a provision. Right. So you are going to make a provision for these 20 staff. But the estimates can keep changing with the experience. Okay. Right. So experience can keep changing. Right. This estimates can keep changing with experience. All right. Now here, there are two areas where you're going to treat it. One is the statement of financial position. Statement of financial position. Right. So here you are going to show a net obligation or asset. Right. And why obligation or asset? Obligation because company has, when the employee is joining the company has already provided them the information and already informed to them that there is such and such benefit that will be offered to the staff that are becoming entitled. Now, since that is communicated, that is there in the employment offer letter, the pledge, the contract, all that contains all the benefits that are outlined, right? Let's assume this benefit is also outlined. So the company knows that there is an obligation that they have, right? But the occurrence of which is going to depend on the entitlement that becomes entitled, or the staff that becomes entitled, right? So occurrence of which is uncertain. It depends on uncertain events. All right. So therefore, since this obligation is already there, the company would never hold an obligation or liquid assets with them. So if they know that there is an obligation that they have of, let's say, we recorded 20 there. So 20 into half of the basic salary. So let's say 100,000 is the basic salary, so 50,000. So that is 1 million. Okay, 50,000 into 20, right? So that's 1 million. And this obligation is already there, right? The company knows that this obligation is there because it was estimated. Now the company is not going to hold liquid asset with them, therefore they are going to invest this money, and earn returns. Okay, so that is the asset component of this obligation. Okay, so if the asset exceeds the obligation, it becomes a net asset. If obligation exceeds the asset, which is the usual context, in that case it becomes net obligation. So net obligation is going to be in the liability section, net asset under asset section. But this is what is more common. Okay. Then there is a second statement, which is statement of profit or loss. Now this is where you're going to record number one, the service cost. Now this is the cost that the employee earns by providing the service, right? Employee earns by providing the service, right? So that's a service cost. Okay. Then there is interest cost, right? Or interest return. So you're going to do it from both the perspectives and take the net, since it's net position that you're doing too, and since net obligation is a more common factor here or more common situation, interest cost is what happens rather than interest income. Okay, a service cost, interest cost, and then remeasurement component. So all this is going to be recognized under statement of profit or loss. This is going to be in your operating section, this in the financing section, and this under operating section as well. Okay, why operating section? Because it is based on the employee service that they're providing for the ordinary course of business. Okay, there is remeasurement component. Now this remeasurement component is what differs when we are going to discuss the defined benefit plan. Okay, so here in this case, all the long-term benefit, you have the net obligation or asset. Then based on that, if there is service cost, it's going to increase the net obligation, right? Service cost increasing, net obligation increases. If service cost increases, net asset reduces. So you know that at the end of the year, the net obligation or asset would be changed based on the service cost, the interest cost, and the remeasurement component. Okay, so remeasurement component is based on the estimate. Now, in the beginning of the year, the estimate was 2%. End of the year, the estimate becomes 4%. So, beginning of the year, we knew that there was 1 million worth of obligation. Let's say there was an corresponding asset of 750,000. So, net position was 250,000. Okay. Now, at the end, it becomes 4%. How many staff? 5. How many staff did you look at? 1,000 staff, right? So 1,000 staff into 4%. So that is 40 staff. 40 staff. 40 staff into 4%, that is 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 40 staff. 40 staff into Okay, 40 staff in total. Right? Now 40 staff into 50,000. Now the closing liability becomes 2 million. Right? Now let's say the asset also increases at the end of the year. Let's say asset does not increase as per the liability. Therefore, let's say asset increases by about 250. Asset becomes 1 million. So there is 1 million of closing liability. Then there will be service cost. Let's say service cost that was relevant to the staff, the 40 staff that you counted, right? The service cost, let's say, of 200,000. Okay, 200,000 service cost. So that is 450,000. 450 and interest rate is 10%. So interest earned on this would be 100,000, or interest cost on obligation 100,000, and interest earned on this would be 75,000. So that is 25,000. All right. So when you look at the total of this, 250 plus 200 plus 25, that's going to be 475,000. Now 475 increases to 1 million at the end of the year. Now this 1 million and 475 has a difference, and that difference is what you call the remeasurement component. Okay, that's how you deal with other long-term employee benefits. So now we move on to the long-term benefit, or now this can be short-term also, which is why I'm not using long-term. Let's use the actual terminology, which is termination benefits. Termination benefits. Remember that termination benefit can be short-term if settled within 12 months. It will be classified as long-term if settled beyond 12 months. Okay, so that's to do with the termination benefit. If it's long-term, follows the rules of the long-term benefits, which is remeasured at the end of each reporting period. Okay, at the end of each reporting period. And short term follows the short term treatment, which is expense and a corresponding liability. Liability settled, re recognized, and reduce your cash. Okay. Now, what is termination benefit? What is termination benefit? Now, termination benefit is when an employer lays off, right? Now, here it can take two forms: employer initiated. So, this is such as employer laying off, layoffs. Okay, layoffs. And then employee initiated, meaning voluntarily accepting the termination. Now, let's say the organization has put out an option of voluntarily accepting termination, right? This is called VRS, right? Voluntary acceptance of termination. Now, this, remember, termination does not equal to resignation. Now, employee-initiated VRS is voluntarily accepted termination, meaning employer offers the option and employee accepts it. So there is no force. But employer-initiated meaning employer forces, meaning there is no any other option. But here, employee can decide to either stay or to go. So when the employer decides to go by accepting the termination voluntarily, that is what falls under the termination benefit category, the VRS. But if the employee resigns, the employer has not asked the employee to resign, go. Employee themselves resign, right? So in that case, that's resignation, and resignation does not require employer to pay anything. But if it is a termination, there will be some money that the employer will have to pay. Lump sum money will have to be paid, right? Lump sum, let's say VRS package or severance package. Right? These are what the termination benefits are. When the employee is being terminated by the employer or the organization, the obligation that the organization has to incur, right? That's what termination benefit is. So it can be short term if settled within 12 months, long term if settled beyond 12 months. Then comes the post employment. Then comes the post employment benefits. So these are the benefits that the organization will be paying to the employee after the employment has ended. This is not termination, not short-term benefit, but any benefit that the employer will have to pay to the employee after the service has ended, the employment has ended. Okay? But as I told you in the beginning, it can take two forms. There is defined contribution plan, and defined benefit plan. Okay? Defined benefit plan. Now, defined contribution plan and defined benefit plan, what's the difference? Difference is about the level of risk, right? It all depends on the level of risk, right? If the risk of paying lies with the employer, right, a fixed amount, that's defined benefit plan, right? Fixed amount meaning employer has promised something, and at the end, employer will have to pay that exact thing that's been promised. That becomes defined benefit plan. But defined contribution plan is employer says, okay, out of your total salary, I'll be paying this much percentage to the scheme, right? So there is a scheme that they'll be paying into, right, in both the situations. But for the situation where the employer says they will pay into the scheme a percentage and that's it, right? If that scheme works, if that scheme fails, it's not their bother, it's not their responsibility. But in the other case, whatever scheme, the post employment scheme that they are investing in, so what they say is they are going to give a fixed amount at the end. Yeah. So even if that scheme fails, they will still have to make the payment for the amount that they have promised. That's what defined benefit plan is. Defined contribution, employer has no risks or no any further obligation apart from the percentage that they are making every month as discussed, or it can be quarterly, whatever they decide on. But if the employer has obligation beyond what they are paying into the scheme to a fixed amount, then that becomes defined benefit plan. Good example for defined contribution plan is provident funds. Provident funds, right? 12% employee provident fund. So 12% is paid by the employer to the provident fund, government. Okay, pays to the government. Now, government, what happens is entity pays to the government, right? Government settles to the employee. Okay. Now, entity pays this percentage to the government. Now, government whether will pay the employee the same amount that was saved, or if the government becomes bankrupt, economic issues, right? If the government faces economic issues, government might absorb that money for their economic recovery. So if the government absorbs it for economic recovery, employee gets zero, and entity has no obligation. Entity does not care, right? What entity is bothered about here is only this percentage to be paid to government fund every month, and then whether government pays that exact fund to this person or not, entity is not bothered. That's defined contribution plan. And this follows the accruals basis, right? Accruals basis, right? Meaning expense when incurred, and then until it's incurred, whatever payment you made, it would follow the liability or asset, accrued expense or prepaid expense. It can be either. If it is before the expense is incurred, prepaid. If it is after the expense is incurred, still not settled, that becomes accrued. All right. So that is defined contribution. Then comes defined benefit. Good example, a classic example here will be gratuity. Gratuity. Let's say gratuity. Now, when the employment offer is being given, the employee knows how much gratuity they'll be paid. Gratuity entitlement 5 years post employment. Post employment, right? That's the condition. And then what's the gratuity payment? Half or 50% of final basic salary multiplied by number of years worked. Let's say 100,000 is the basic salary. 50% of that is 50,000. Let's say they worked for 10 years into 10. 500,000. Now here they are promising this amount, this value. Now this 50,000, 100,000, let's say, is at the end of year 1. But at the end of year 2, 100,000 can become 200,000. There can be an increment, right? There can be a promotion. Okay? So in that case, if 100,000 becomes 200,000, even this will increase, right? Now this becomes 100,000 into 10, which becomes not 500,000 now, but 1 million at the end of year 2. And likewise, it may keep changing every year based on the change in estimates and the practical situations, which is why defined benefit plan will keep changing and there'll be a remeasurement that will keep happening. Okay? And to do this remeasurement, there'll be someone called an actuarial, an expert, right? Actuarial valuation, right? This will be done by an actuary. That is the expert that can evaluate and forecast what's going to be the increment, how many employees are going to remain for how many years, how many employees are going to resign or terminate the employment before they get entitled to whatnot. All that will be estimated by an actuary. So what are the main estimates that actuaries make? To understand how the company is going to settle, or what's the obligation the company is going to have, and how is the obligation going to change. So what are the factors that actuaries are going to consider, right? So actuarial valuation, the actuary would consider factors such as salary growth rate, right? Growth rate meaning how much our salary is going to increase by, let's say, 5% annually. Now this happens every year, right? Actually does the estimate every year. And every year the estimates will keep changing. Then there will be retirement age that they estimate. They estimate at 60, right? 60 years. Let's talk about year 1, 60 years. Then there will be mortality rate, meaning how long will they live, right? That's mortality rate. Then there is employee turnover, meaning how many will leave before the entitlement, right? Now 5 years, this is the condition for entitlement, right? Now how many are going to leave before that, and how many are going to be there beyond that period? Then discount rate, right? So rate in discount rate is going to be the rate that is going to be considered for interest, expenses, and income. So what's that going to be? Right, so these are going to be some of the factors that the actuaries would consider in making the actuarial assumptions. Okay, and based on that, the actuarial will keep changing the estimates every year, and because of that estimate keeps changing every year, there will be changes in the obligation and the assets. Okay, right. So there are two components here. Now how are you going to deal with this? Number one, so there are steps. You can call it step one rather, right? Step one, you have to determine the net defined benefit or asset position, right? So net defined benefit or asset position. So in this case, there will be net surplus or net deficit. All right. And net deficit is the more common factor. Net deficit is the more common factor because we'll see how you calculate it, right? So you'll understand why net deficit is the more common factor. Now, if the obligation, so you call it defined benefit obligation versus defined benefit asset, right? Okay. If DBO exceeds DBA, meaning obligation exceeds the asset, if this happens, it's a net deficit. And more often than not, DBAO is going to be higher than DBA. If DBA is higher, there are further rules, right? To avoid recognizing the entire DBA amount or entire net surplus. So there is a cap there, right? So if DBA exceeds DBO, that is net surplus. So in this case, there comes a ceiling. We call it asset ceiling, meaning a cap. You cannot recognize beyond that amount. Okay, you can't recognize beyond that amount. So that's step number one. You identify whether is it a net defined benefit or net defined asset, meaning net the deficit or net surplus. All right. So how do you calculate the DBO? DBO is going to be the present value of defined benefit obligation, right? Present value of the obligation, meaning you are going to look at how much you are going to pay in the future and you make a present value calculation there using the discounting factor. Okay, that's also one of the areas where discount factor is important. And DBA is going to be fair value of plan assets. Right? So asset is going to be fair value at a recognized fair value and DBO or obligation at present value. Okay, that's a calculation that you do. And if DBO is exceeding DBA, there is net deficit or net surplus if DBA is exceeding the DBO. Okay, so usually you use 3-column method of calculation, right? What's 3-column method? So first you start practicing with 3-column and then net position becomes easier. What's 3-column? You have DBO, you have DBA, and you have net position. All right, you have DBO, DBA, and you have net position. So DBO you will have, let's say, brought down, right? Opening balance, right? Meaning brought forward. Then we looked at other components: service cost, interest. No, not just expense, because there is an asset and expense both. Okay. Then there is going to be closing balance. Closing balance, meaning carried down. It's not closing balance, it's carried, you call it carried down, liability carried down, because there is going to be calculations. This is going to be the actuarial valuation. Okay. Then you will have paid contributions. Okay, you will have paid benefits, right? Contributions. Now, contributions is where the organization pays cash to the net asset, right? And then benefit paid, meaning let's say someone becomes entitled, so if the organization is paying for them, that reduces their liability as well as reduces their plan assets. Okay, so good example is gratuity or pension scheme. Yeah, so the organization, they make sure that there is a pension fund, right, for which they keep investing into, right, until they are required to make the payment. Okay, so this is where the pension fund comes in, and this is the obligation that they have. Okay, now let's discuss these in detail. All right, so then comes step 2. Let's move into step 2. Right, step 2. Step 2 is recognizing the statement of profit or loss components. Right, recognize the statement of profit or loss components. So you have service cost. Now, service cost can be current service cost, or it can be past service cost, right? Past service cost. Now, this is the cost of additional benefits, right? Additional benefits earned by the employee. Earned by the employee meaning, let's say they've provided service, so they are paid for the service, right? Or they will have to be paid for the service. So when they're providing a service in the current year, that additional benefit that they are getting entitled to, mean a service that they provided for this period, they are being entitled to, right? So they are earning it. That is what service cost is. The service that they are rendering, whatever they are becoming entitled to. Because current is within the current period. All right. Past service cost depends on plan amendments, curtailments, and settlements, right? PACS. So we'll discuss what those are shortly. All right. Then net interest. Net interest, that's component number 1. Component number 2 is interest component, right? Interest component. So this is going to be the interest expense. Interest expense on the obligation. Why? Why interest expense on the obligation? You go back to the rule of unwinding, right? What is obligation? Obligation is the present value, right? Obligation is the present value. See, it's present value. Now, if something is at present value, you have to keep unwinding until it reaches the value that you're supposed to pay, the future value, right? So, unwinding cost, you call it unwinding cost as well. So, interest expense on obligation, you use the discounting factor that you use to bring that to present value, and that is going to increase the obligation. All right, that's going to increase the obligation. And then you have interest income. Okay, interest income on plan assets, meaning whatever return you have got, return on investment, you call it return on investment as well. And then you look at the net position and you arrive at whether it's a net interest expense or net interest income. Usually it's net interest expense. Okay, those are the two components that's to be recognized under statement of profit or loss. Then comes step number three. Step number three, right, which is recognizing OCI components. Now, if you recall, we recognize the remeasurement bear component under SPL in other long-term benefit context, but here the first component here is going to be the actuarial gains or losses. Remeasurement difference. Right? Actuarial gains or losses you recognize through other comprehensive income, OCI. Alright, because these keep changing and there's a lot of uncertainty. In other long term, there's no uncertainty as such. There's not much of an uncertainty. Here, there's a lot of uncertainty because of all the. Why a lot of uncertainty? If you even look at the categories that they're going to look at through, you see that it's not going to be very straightforward. So, because of all the uncertainty that is involved, it goes under OCI. Why? Because OCI is a place for the gains or losses that are low quality, right? That are low quality. So until it becomes, until it's earned, it will remain low quality. So that's number one, that's being recognized here. Number two is the difference between expected and actual return. Right? Now this also can be positive or negative. Right? Let's assume you expected 5%. This 5% you are going to recognize under SPL, the interest component. But the actual return ended up being 8%. Now you see there's a difference, right? Your expected return was 5%, actual return is 8%. Now there is a difference of 3%, right? There is a difference of 3%. Now this 3% is going under OCI. 5% under SPL, 3% under OCI. That's what the second component of OCI is. Difference between expected and actual returns on planned asset. Okay? Right. Then, third, it is change in asset ceiling. Right? So remember, this excludes the interest income because the interest income you're receiving from the bank itself. Exclude interest income. It can be other types of returns, excluding interest income. Then the change in asset ceiling. As we discussed, there is a cap. Cap. You cannot recognize beyond that cap. Now, what is the cap? So, asset ceiling is the expected returns in terms of refunds or reduction in expense. Right? Now, let's say there is an amount that you have, but there is an amount of which there will be future returns or refunds that you can estimate. But if your DBO is less than your DBA, and the difference, let's say, is 250,000, right? 250,000 net surplus. But the refunds or the reduction available in the future, meaning the economic benefit that can be derived in the future, is 150,000, right? Although there is 250,000, which is the difference, But only 150,000 is recoverable, meaning can be recovered through either refunds or reduction in future expense. So in that case, 150,000 is what you can record. Okay, you cannot record in full. It's going to be lower. It's going to be lower of net surplus and the net returns in the expected benefits in the future. So expected benefits could be through refund or reduction in future expenses. That's what asset ceiling is. What is asset ceiling once again? Asset ceiling. Asset ceiling is lower of net surplus and future economic benefits. Right? A future economic benefits is available through refunds or reduction in cost. Okay? So you take lower of it. If net surplus is higher, the lower is the future economic benefit. This is the value that will be taken. So this is the cap. But if this is lower, you can recognize this in full. Okay, if you know that refund is going to be higher, then you can take it in full. Otherwise, more often than not, there will be a cap. Alright, so that is the recognition of OCI components. And then, final step, right? Step 4, reconciliation. Right? Reconciliation. Now, for this reconciliation is why you are going to use the table, 3-column table, right? DBO, DBA, net. Okay, and you reconcile that. Now let's give these figures. 1,750,000. So net position is 250. We know it's net deficit. Net deficit meaning anything that increases the obligation is going to increase the net position. Okay, so that's brought forward. Then let's say service cost. Service cost for the period increases the obligation by 250. No change here. So that's going to increase the net obligation by 250. Okay. Interest at 10%. So the DBO interest 1000 into 10%, right? 1000 into 10%, that is 100. Why? This is 1000 into 10%. Okay. Then 750 into 10% is 75. How? 750 into 10%. Alright. So that's interest. So what is the net position? 100 minus 75, 25 is the net position here. Okay. And then let's say there was a contribution that was made. Contribution, your cash goes down, your cash is credit, and it debits your planned assets. Your DBA increases by 175. Okay. So since this is increasing, it is reducing the deficit, right? So you're going to deduct it, 175. Then you have the closing figures, right? So actuarial calculation, based on actuarial calculation, the actuary has provided the closing figures. Okay, so closing figures provided by actuary is 1,500 here, and in this case it's 800, 850, 850. Okay, that's what the actuary has provided. Now there'll be difference. 1,250 plus 100 is 1,350. 1,500 and 1,350, there's a difference of 150. Now we arrive at the remeasurement component, or you call it actuarial gain and losses, right? Actual gains or losses. Now what's the figure here? 750 plus 75 plus 175. Yes, so 170 plus 75 is 250. 750 plus 250 is 1000. 1000 becomes 850. 1000 becomes 850. So this goes down by 150. Or let's make it a little difference, otherwise there is not going to be any changes there. Right, so let's make it 900. Okay, 750 plus 250 is 1000. 1000 becomes 900. 1000 becoming 900, meaning there is a remeasurement loss. Now, remeasurement is also remeasurement loss. Why? Liability is going up. Remeasurement actuarial loss. Liability goes up. Actuarial loss, the asset goes down. So overall, 150 minus 100. Okay, so that's going to be 50 actuarial loss. Okay, 1500 minus 900 is going to be 600. If you look at the values, 250 plus 250, 500, 525, 525 minus 175 plus 50 gives you 600 as the figure. Right? 600 as the figure. Now, this is based on actuarial calculation. And this difference is going to be the difference between total and the actuarial figures that's been given. Okay, so that's how you do the reconciliation, and the net position, the 600, is what will be recognized in your non-current liability. Okay, so that's how you are going to deal with the net benefit or net benefit obligation, net benefit asset. In a nutshell, the net benefit plan. Okay, now once you master this 3-column setup, you will be able to do the net position even without using this. Okay, so you have to master 3-column in order to end up mastering the net position, because in the exam, more often than not, having the net position is good enough. But to practice that, you will have to do DBO, DBA, and once you're used to that, you will have it in the head. You will already know how to deal with this situation and what is going to be the net position accordingly. All right. And then there is past service cost that is pending. Past service cost. Now, this is dependent on plan, amendment, settlement, curtailment. Okay. Amendment, changes. Settlement, settling. You understand that by the term itself. Curtailment, reduction. Okay, reduction in the employees covered. So this is what amendment, settlement, curtailment is. So any change to defined benefit plan, is covered through this. Now, any change that happens is going to impact the past service cost. Okay, past service cost. Now, past service cost can be positive or it can be negative. Right? It can either be positive or it can be negative. Okay, so positive past service cost is going to be added or increasing the deficit, and negative is going to reduce the deficit. Okay, now how can that happen? Now, how can this happen? Change, right? Any change that happens, so change that increases the bring a positive value to the service cost, the past service cost, could be maybe the increase in the present value of obligation, right? Increase in the present value of obligation. Now, this could be a situation where additional benefits are introduced, meaning now the employees are being provided extra benefits from what was agreed. So if they are being provided extra benefits, that is covered here. Okay, and then there will be a situation where the benefits are reduced. If the benefits are reduced, right, It can either be through a reduction of employees, right? A reduction in the plan itself, yeah. So that can make it leave a positive impact on the organization. And when that leaves a positive impact on the organization, the service cost reduces. So when service cost reduces, it's going to reduce the deficit as well. All right. So when we look at the amendment, right? When we look at the amendment, it is the change that can happen to the defined benefit plan. Now, change can happen either due to introduction of a new plan, right? Or withdrawal of an existing plan, withdrawal of an existing plan, or change to an existing plan. Okay, change to an existing plan. If any of this happens, there is an amendment that's happening. And curtailment is reduction in the number of employees covered. Okay, so reduction in the number of employees covered. That is what curtailment is. And settlement is elimination of further obligations for a part or full, right? Full benefits. Okay. So how can the elimination happen? Now, curtailment, we know when the number of employees covered are reduced, it's curtailment, right? Maybe some staff have left, some have been terminated, right? So that is the curtailment. But settlement is where the elimination of further obligations, meaning you have maybe transferred the staff to a different company, or you have transferred the obligation to an insurance company. So in that case, what happens? There's an elimination. When an elimination happens, that's what settlement is. Okay, that's what settlement is. Now let's assume that initially $1,000, or we'll go back to our example, right? Initially it was 50%. Okay, 50% of salary into number of years. Okay, this was how the gratuity or the pension was to be calculated. But now they made a change. Where it's 75% of salary into number of years. So you see there is a increase, right? Change in the plan, 25% increase. So this creates a positive change, meaning now the service cost of employees, whatever service they're providing, now they'll be providing at a higher rate. Okay, so whatever the amount you divide by number of years they've been there, you divide by number of months that they work, every month you are going to increase their gratuity or post-employment obligation by that amount. Now at this point, by 25% if it's increasing, now this 25% will be considered a past service cost. It's going to change all the past values also because you've recorded it at 50% in the past. But now they're saying 75%. So this 25% you also have to go and amend the past records. So when you go and amend the past records, that's what the past service cost is. And in future, it is going to be 75% value that you are going to make provisions on. So that is positive past service cost. And negative past service cost would be other way around. Let's say 50% becomes 25%. So now here the reduction in plan is of 25%. Here it was increase, here it is reduction. Now this reduction would create a negative past service cost. Alright. And then comes settlement. Now that's the service cost, the positive, negative that we just looked at. Then comes a settlement. So in terms of curtailment, it's going to be a negative past service cost. But in terms of settlement, now settlement, let's say you have the obligation of 1 million. So out of that, 500,000 you are giving away to the insurer, right? So 500,000 worth of obligation you are giving away to the insurer. Okay. Now insurer charges from you 400,000. So what happened? You were able to exhaust the obligation of 500,000 by paying 400,000. So there is a gain of 100,000, right? There's a gain of 100,000. So this will be a gain, past service cost impact, where it will be negative past service cost because gain is going to reduce the deficit. Okay, but if it's other way around, 500,000 worth of DBO has been transferred to the insurer by paying 600,000. So what happened? You've incurred 100,000 extra cost, right? So 100,000 is a loss on settlement. This loss on settlement will be added to past service cost. Okay, so this is going to reduce the past service cost. This is going to increase the past service cost. Okay, that's what past service cost is. All right. So in a summary, if you look at IAS 19, the employee benefits, you have short-term benefits, you have long-term benefits. There are other long-term benefits apart from termination and post-employment. Then there's termination benefits, there's post-employment benefits. Termination can be short-term or long-term depending on the settlement. Post-employment, there's a defined contribution plan, defined benefit plan. Defined contribution, the risk does not lie with the employer or the employee. So employee is liable only to pay the percentage, while defined benefit plan, the employer is responsible to pay the end value, and there is a lot of uncertainty that keeps changing, which is why there is a detailed assessment, a detailed calculation that you do with defined benefit plan by following the 4-step method. The first step is you identify the net deficit or net surplus position. Then the second step, you recognize the P&L components, which is service cost component, could be current service cost, which they have been entitled by providing service for the current year, past service cost that has happened due to an amendment, curtailment, or settlement. Then the net interest, it can be cost or an income, but more often than not, it is going to be cost. So there you are going to bring the net interest, which is going to increase or decrease the net deficit or net surplus based on where the value lies. And then you have the contribution where you're paying cash to increase the asset, which is going to reduce the deficit or increase the surplus. All right. And then you will have the closing figure, which will be calculated by an actuary. The actuary will be calculating and providing it. And any difference is going to be the actuarial gain or loss, remeasurement component. And remeasurement component or the actual gain or loss is going to be recorded under OCA, which is the step number 3, recognizing OCA component. Number 1 is going to be actual gain or losses. Number 2 is going to be the difference between the expected and the actual return on plan assets. And number 3 is going to be the changes in asset ceiling, right? Asset ceiling, as you understood, is the cap of recording the net surplus, and a plan amendment, curtailment, settlement is changed to the existing defined benefit plan, whereas there can be an introduction of a new plan, withdrawal of an existing plan, or any changes. Curtailment, reduction in number of employees, settlement, elimination of further obligation. So this is what IAS 19 employee benefits is for you. And then we have IFRS 2, which is another new standard for SBR students that we are going to look at.